what if the dollar doesn't crash? It just slowly bleeds out while everyone pretends not to notice. Look, I need to show you something that's been sitting in plain sight, but somehow nobody's talking about it the way they should be. The U.S. national debt just crossed $38.56 trillion. That's not a projection. That's not a worst-case scenario. That's the number right now, as of early February 2026. And here's the kicker. It's growing by $6.43 billion every single day. I know. We've heard the debt is too high for decades. But here's where it gets weird. The interest payments alone are about to hit $1 trillion annually. That's not paying down the debt. That's just the cost of having the debt. It's now eating up nearly 14% of everything the federal government spends. For context, that's more than we spend on most cabinet-level departments. We're paying more in interest than we spend on veterans, education, or infrastructure. So why isn't this front-page news every single day? Because the story everyone's been trained to watch for is the dramatic collapse, the overnight crisis, the market meltdown, the emergency Fed meeting at midnight. But that's not how this works. What we're watching instead is something far more insidious. It's a slow-motion devaluation that doesn't require a crisis to justify it. It just requires math. Let me back up. The average interest rate on U.S. debt was around 1.5% just 5 years ago. Today, it's 3.348%. That might not sound like much, but when you're dealing with nearly $39 trillion, small percentages become absolutely massive numbers. We went from a low-cost debt regime to a high-service-cost debt regime in basically one Fed tightening cycle. Here's the part they aren't telling you. The government has to issue roughly $12 trillion in debt this year. Not because we're spending $12 trillion more than we take in, though the deficit's heading toward $2 trillion annually, but because old debt matures and has to be rolled over, refinanced. Except now, instead of refinancing at 1.5%, we're doing it at over 3%. Every piece of debt that rolls over instantly becomes more expensive to service. It's like refinancing your mortgage, but instead of getting a better rate, you're locked into a worse one forever. And then, in late 2025, Congress passed something called the One Big Beautiful Bill Act. I spent way too much time reading this thing. It locked in permanent tax cuts and ramped up defense and infrastructure spending. Translation, we've baked in $2 trillion deficits as the new normal, regardless of whether the economy's booming or tanking. Growth doesn't fix this anymore. We've structurally locked ourselves into needing to borrow massive amounts every single year. Now, enter Kevin Warsh. He was just nominated to replace Jerome Powell as Fed Chair in May 2026. The markets had a very strange reaction when this was announced. They did what's called a bear steepening. Long-term bond yields went up, which usually signals investors are worried about debt and inflation. But short-term futures started pricing in rate cuts. So the market's basically saying, we think Warsh is going to cut rates to help the economy, but we also think that's going to make the long-term debt situation worse. Here's where Warsh's strategy gets really interesting, and frankly, risky. He's proposing a dual-track approach. Cut short-term interest rates to ease pressure on borrowers and stimulate growth. That's the political win, the thing the White House wants heading into the 2026 midterms. But at the same time, aggressively shrink the Fed's balance sheet. The Fed's still sitting on over $7 trillion in bonds they bought during QE and the pandemic. Warsh wants to sell those off to normalize the economy and restore what he calls Fed orthodoxy. On paper, that sounds fine. Lower rates for Main Street, tighter money for Wall Street. But here's the problem. If the Fed is selling trillions of dollars in bonds, at the same time the Treasury is issuing trillions more to fund the deficit, who exactly is buying all this debt? Private investors are already hesitant. Foreign creditors, China, Japan, the Gulf states, have been quietly reducing their Treasury holdings. They're not dumping everything overnight, but the trend is clear. They're diversifying away from dollar-denominated assets. So when there aren't enough private buyers, guess who steps in? The Fed. Even if they say they're shrinking the balance sheet, they become the buyer of last resort to prevent a failed Treasury auction. And what does that mean? It means they're printing money to buy government debt. That's debt monetization. It's not called that in the press releases, but that's what it is. Ray Dalio's been warning about this for a while now. He's got this framework he calls the big cycle of debt and power. We're supposedly in stage 5, the endgame where internal conflict and external pressures force a country to print money to fund both domestic programs and military obligations. Guns and butter, as the saying goes. And when you do that, currency debasement isn't a policy choice. It's inevitable. Now, here's what's really telling. In previous cycles, when U.S. interest rates went up, the dollar strengthened. Basic economics. Higher rates attract foreign capital seeking yield. But in 2025 and into 2026, we're seeing the opposite. Rates are rising and the dollar is falling. The dollar index dropped about 11% in the first half of 2025. It's recovered a bit since Warsh's nomination, but it's volatile and weak. This is what's called a fiscal risk premium. Investors aren't viewing U.S. debt as a safe haven anymore. They're viewing it as a credit risk. They're demanding higher yields, not because they want dollars, but because they're worried about getting paid back in dollars that are worth less. The dollar and treasuries are weakening at the same time. That's not supposed to happen to the world's reserve currency. I dug through the data, trying to find a historical parallel, and it's genuinely hard to find one. The U.S. has never been in this position before. Dominant global military, reserve currency status, but with a debt load this large and growing this fast, while facing legitimate geopolitical rivals and a polarized domestic political system. Let's talk about the opposing view for a second, because it's important. There are smart people who think this is all overblown. The productivity miracle crowd argues that AI is going to do for the 2020s what the internet did for the 1990s. Massive gains in efficiency, economic growth above 3 to 4% annually, and suddenly the debt-to-GDP ratio stabilizes or even improves. Warsh himself has hinted at this. If we grow fast enough, we grow out of the problem without needing devaluation. And look, I'm not dismissing that. It's possible. AI could be transformative. But here's my issue with that argument. It requires everything to go right. It requires AI to boost productivity across the entire economy, not just tech. It requires that productivity to translate into tax revenue. It requires no recessions, no financial accidents, no geopolitical shocks. And historically, betting on everything goes right is a losing bet. There's also the dollar milkshake theory. The idea here is that, yeah, the US has problems, but Europe, Japan, and China have worse problems. Demographics are terrible across the developed world. China's dealing with a property crisis and demographic collapse. Europe's energy dependent and fragmented. So money flows to the US by default. It's the cleanest dirty shirt. That's been true. But notice the word choice there. Has been. The question isn't whether the dollar is better than the euro or the yen. The question is whether faith in the dollar as a neutral, stable store of value is eroding. And the data suggests it is, slowly. Gold is up about 10% since late 2025. That's not a speculative frenzy. That's central banks and large funds quietly moving into hard assets. Bitcoin's also being accumulated by a certain type of investor, specifically as a debasement hedge, though it's still too volatile to be the primary alternative for most institutions. Here's what keeps me up at night. This isn't a crisis that announces itself. There's no single day where everything breaks. Instead, it's a series of small decisions by millions of actors. Pension funds rebalancing away from treasuries, foreign governments settling trade in other currencies, corporations holding more cash and non-dollar assets. Each one makes sense individually, but collectively, they create a feedback loop. And then there's the tariff situation. The current administration has implemented tariffs up to 60% on certain imports. The stated goal is to bring manufacturing back and reduce the trade deficit. But tariffs are inflationary. They raise the cost of goods. That makes it harder for the Fed to cut rates, because cutting rates while inflation's rising is how you get stagflation. And stagflation, high inflation, low growth, makes the deficit worse, because you're paying more to service the debt, while tax revenues stagnate or fall. So you've got this trap: political pressure to cut rates and stimulate growth, tariffs pushing inflation higher, a Fed chair trying to shrink the balance sheet while the Treasury needs massive bond purchases, and a dollar that's supposed to be strong but keeps weakening whenever anyone looks too closely at the numbers. There's a term I keep seeing in the research: confidence erosion. The dollar isn't going to be devalued by decree. There's not going to be a policy announcement that says, "We're devaluing." Instead, the market realizes, slowly and then suddenly, that the US can't service $39 trillion in liabilities with hard currency, not without inflating it away. And that's the subtle part. Inflating the debt away isn't a dramatic event. It's just persistent 4 to 6% inflation, while revenues grow at 2 to 3%. Over a decade, that cuts the real value of the debt nearly in half. Bondholders lose in real terms, but nominally everything looks fine. The government makes its payments. No default, just a slow transfer of wealth from creditors to debtors. That's what Dalio means when he talks about the arithmetic limit. It's not that the system collapses, it's that the math stops working unless you devalue. And once the market figures that out, it prices it in. Yields rise, the dollar weakens, and the spiral accelerates. I keep coming back to one fact. Net interest is now the fastest growing line item in the federal budget. Not Social Security, not Medicare, not defense. Interest on the debt, and it's growing faster than revenues. That's the definition of unsustainable. So what happens next? Honestly, I think we're in the early innings of a long, messy process. Warsh takes over the Fed in May. He'll try to thread the needle, cut rates just enough to avoid a recession, sell just enough bonds to claim he's normalizing policy, but not so much that he crashes the Treasury market. It's an incredibly difficult balancing act, and the political pressure will be immense. If he succeeds, maybe we buy another few years. Growth picks up, deficits shrink a bit, and we kick the can further down the road. But if he fails, if the bond market revolts, if inflation spikes, if foreign creditors accelerate their exit, then we're looking at a genuine currency crisis. Not hyperinflation, probably, but a serious loss of purchasing power and global reserve status. And here's the thing nobody wants to say out loud. There might not be a right answer here. Maybe the debt's already too large to manage without some form of devaluation. Maybe we're just negotiating the terms of how it happens. Do we really believe this ends with everything fine and the dollar as strong as ever? Or are we watching the slow unraveling of a system that worked brilliantly for 80 years, but has finally hit its mathematical limits? I don't have a clean answer, but I know this. When the math stops working, something has to give. And right now, the math isn't working.